We're going to start with the number. And fair warning, it should probably make you a little uncomfortable.
So what is it? 50%. This isn't an opinion or some wild guess. It's a hard fact from the European Central Bank. Half of all net wealth is owned by just the top 10% of households. Let that sink in. This isn't just a statistic. It's the financial reality we are all living in right now.
So, the only question that really matters is this: how do you get on the right side of that number? And the answer? Well, it isn't what most people think. We're going to use data to find the real answer to that one crucial question.
You know, we're all taught that a high salary is the key to wealth. But the data, it reveals a much more powerful force at play. It's all about the first major financial decision you make.
Okay, let's start here. Your earning power, your human capital, is the engine that drives your early wealth stages. Think about it. Your skills, your education, your ability to actually earn an income. This is your starting point, the raw energy you have to work with. But here's the catch. Having a powerful engine is pretty useless if you don't connect it to the wheels, right? So how you convert that power into actual assets, that's the real test. Let's look at a super common scenario. Two people, same starting line, who convert their human capital into very different kinds of financial fuel.
And let's be really clear here. Both of these people are being financially responsible. They're both saving. But the renter is turning their income into cash, which, as we know, is always vulnerable to inflation. The homeowner, on the other hand, is converting it into an asset. They're building equity through a forced savings plan, that's what a mortgage really is, while also benefiting from appreciation. Over years, these two paths don't just diverge, they lead to entirely different financial worlds.
So if ownership is so critical, let's break it down. What does wealth actually look like for the average household? What assets are people really using to build their net worth? Well, the data from the ECB study shows the sheer dominance of one category. The main home you live in makes up over half, 56%, of the average household's net wealth in the Eurozone. You add in other real estate, and you're at a whopping 77%. Everything else, businesses, stocks, bonds, it's all a distant second. Just think about that for a second. This isn't some motivational quote. It's a simple, stark conclusion from the data. For most people, their home isn't just an asset. It is the asset. The financial foundation for the vast majority of people is the property they live in.
Now, how do we know this single factor is so important in shaping that 50% number we started with? Well, economists use a specific tool to measure inequality with mathematical precision. It's called the Gini coefficient, and it's basically just a simple score. 0 means everyone has exactly the same amount of wealth, perfect equality. 1 means a single person has all of it, total inequality. So the higher the number, the more unequitable the distribution is. Simple. This chart, the Lorenz curve, is a brilliant way to see how it works. That straight line, that represents a world with perfect equality. The curved line below it shows the reality of how wealth is actually distributed. The Gini coefficient is simply a measure of the gap between that ideal and our reality. The bigger the gap, the greater the inequality.
So what happens when economists use this exact tool to analyze the wealth of homeowners versus non-homeowners? The results are not just different. They describe two completely separate financial games being played.
The European Central Bank study calculated the Gini coefficient for these two distinct groups. And the results are, well, they're stark. Among homeowners, wealth is much more equally distributed. But among non-homeowners, wealth is far, far less equally distributed. And this leads us to the big aha moment of this whole thing. The main source of wealth inequality isn't just rich versus poor, it's owners versus non-owners. The data suggests the biggest financial fault line in society is between those who own their primary residence and those who do not. Understanding this, it really shifts your entire financial perspective. It reframes the role of a home from being just a major expense to being a foundational piece of a long-term strategy. So why does a home act as a wealth equalizer? The study points to a few key reasons. First, it's a form of forced savings, building your equity every single month. Its value is also less concentrated among the super rich compared to financial assets. It provides a stable base for future wealth accumulation. And honestly, for most households, it's the primary way they will ever build significant equity. So the key insight here isn't that you must buy a house tomorrow, is to recognize what the data is telling us about the foundational role of this one asset. Your home isn't just shelter. It's the financial foundation you build everything else on. Your first major strategic goal shouldn't just be to earn more, but to figure out your path to owning the ground you stand on. Because that, according to the data, is the first step to getting on the right side of the 50% rule.